work in progress, and return asset. And the return asset would be 180. And you would credit inventory 6,000. Why does it keep making these noises? Is that clear? So it's very different than IS 18. Because in IS 18, what you would have done is you would have taken the whole amount to cost of goods sold, right? And then you would have had a provision for the profit. And you normally would have taken that provision against revenue, right? I mean, it wasn't prescribed in IS 18 how to do it. But that's what was a bit more casual how it was done. Is that clear? When it comes to breakages, I think this is really the same as before. So if you have 100 flights, they're two-way flights, there's 200 flights, and you charge for the flight, let's say $500, you would take your total revenue and you would divide that by the number of flights you expect to take. So if there's 100 return tickets and you expect 50 people to go only one direction, there's 150 flights, right? So you would take the total revenue, what you charge because you sell tickets as a package, you divide it by the expected flights. That's called breakage. Is that clear? Yes? So you would simply allocate the revenue, which would be 200 one-way tickets, because people buy them as a return, is $10,000. And we expect to do 150 flights, so 10,000 divided by 150. Every time a flight is flown, that's what you're going to book. With breakage, you always estimate, you take the unearned revenue, and you always allocate it over the remaining obligations to deliver. You don't go back and adjust. It's always prospective. So I think this is pretty similar to before. This didn't really change that much. What is more explicit now is when they talk about warranties. And what we're going to do is break them down into two categories. There's the standard warranty and the extended warranty. So a standard warranty is not a PO. A PO is a performance obligation. So therefore, when you have a standard warranty, it has no impact on revenue. So the thing for the performance obligation, it has to be more substantive. So they make a distinction between that and an extended warranty. An extended warranty is a separate performance obligation. And with the extended warranty, let me just turn my sound off here. With the extended warranty, what did I do there? So the thing about what's new is the extended warranty is a separate performance obligation. So obviously you're going to allocate revenue to that, which will be deferred and booked over the warranty period. We also have to be careful about other products. So if we offer training when we sell a product, that's a separate PO. Any installation, etc. We have to be very careful. There's a bit more analysis here. Now, for it to be a performance obligation, the key thing there, it has to be substantive. So there's an example in the standard or in some of the literature where you buy a virus program. And what you need to do then is email the virus company, the software company, the username and people's email address. And they take that to stick it in the system to give you your access code. Is that a performance obligation? Actually, no, that's considered to be an admin task. So we need to be careful because there's a difference between an admin task and a performance obligation. So if an admin task doesn't, so a performance obligation must give a clear, separate benefit to the customer. So the whole thing about POs, performance obligation, is the customer has a separate benefit. So it's not from the supplier's perspective, it's from the recipient's perspective. So warranties, training, anything else needs to be separate and split.
But why is standard warranty not
Because the conceptual basis of this is a standard warranty is saying, when I give you a product, I'm guaranteeing to you that it's going to work. And the standard warranty is designed to cover defects at point of transfer. Where an extended warranty is designed to cover defects that are your fault from using it. That's the conceptual basis.
But when you're selling the product to the consumer, you must have built in some revenue for standard warranty also.
Yeah, but the argument is the cost. It's not a revenue transaction. It's a cost of deliverable. I'm going to give you this chair. Some chairs have some minor defects and have to come back and be fixed. So the argument is that's part of the performance obligation. It's not separate.
It's part of the original
Correct. Correct. So it's part of the original PO.
If the customer has an option to buy the product at a discounted amount without any standard warranty, then would the standard warranty become the performance obligation? Then you can buy the product at a lower price if you do not avail the standard warranty provision.
I have never seen that. Does that exist here in Pakistan? Or is that an academic answer from an examiner? You're an examiner, right?
Yes. For
So,
cell phones, it can be an option that you can purchase cell phones without any warranty at a lower amount.
because it's from the black market, you're saying, right? Is that what you mean?
For the real market is
I've never seen that scenario unless you're buying something from the black market, like the... It's what? It's a normal... So you can choose to buy from a normal vendor with no standard warranty or with a standard warranty. Then by definition, is it a standard warranty?
So consider a refurbished product. So the company is not offering the same warranty as with.
If it's a refurbished product, and refurbished products have different warranties than new products, that's different.
Yeah.
So
even for the laptops, it is the same way that if you buy the laptops with warranty, they are at a higher amount, and you can buy the same laptop without any warranty at a lower amount.
Then to me, that's not a standard warranty, because the spirit of a standard warranty is it comes with the product. You can't unbundle it. The moment it's unbundled, then it's an extended warranty by default.
That is a separate performance.
Correct. So the idea of a standard warranty, I mean, there was a lot of discussion about this. And over the years, as it was written in the exposure draft, the initial analysis was a standard warranty covers defects at time of purchase, and an extended warranty covers defects that happen from usage. That's the conceptual basis. But obviously it gets very academic. So they say if it's a standard routine warranty, you just keep it together. The other example that someone had yesterday was, what was the question someone asked me yesterday? Yeah, the free service. So you work at a car company, right? So you buy a car, and you get your first service of 5,000 or 10,000 kilometers for free. I haven't seen this example in the standards, but I would view that like it's part of the initial purchase of PO, performance obligation. You bought a car, your first oil changes, it comes with it. I wouldn't treat that as a separate PO. Number one, it's not very material, right? You buy a car for, here it's expensive, right? You have expensive cars here, $20,000 for a Honda, and you get a free oil change. Thank you very much, Honda, right? So you made your profit, okay. I would treat that as this, it's not as a separate PO. It's not significant. It's part of, if it's customary and part of the process, and it's like a check to make sure everything is A-OK, to me that's kind of similar to your standard warranty. And if it's...
Should we book upon sale or we should wait for the whole thing?
No, I would book it like a warranty. I book the sale up front, and I book a provision per IS 37. So the standard warranty is per IS 37. The extended warranty is in IFRS 15. You defer the revenue. I would not defer the revenue for that. That would be too much. Onerous contracts are still the same in the scope of IS 37. Again, US GAAP has its own guidance on that matter, but in IFRS, nothing's changed there. Here's what's different. One of the differences, if I compare US accounting with IFRS when it comes to fixed assets acquisitions. In US GAAP, you have to demonstrate that the cost is incremental. And they're concerned about companies taking part of their overheads or their fixed cost structure and capitalizing it. So in US GAAP, there's a huge emphasis on incremental cost. Now, when it came to IFRS 15, they copied that from the Americans only for cost to obtain the contract. So we have two categories of cost: fulfillment cost and cost to win the business. Now, fulfillment costs are still the same. We can still have an allocation of fixed overheads. And we don't have the emphasis like US GAAP does on incremental cost. So in IFRS, fulfillment costs include incremental and non-incremental cost, and you take all of those, nothing's changed. That's IS2. Nothing's changed there. But when it comes to cost to win business, we went the US GAAP way, and what they've said here is the incremental cost to win the business would be capitalized and amortized over the period of time to earn the revenue. So if you look at, for example, where is it? Number 8 on page 100. Example 8, page 100. This is a good exam question, right? It's too easy.
Similar to the one already in standard.
So basically, if this was a fulfillment cost, you would take the $12,000 and $2,400, and they would go to inventory and they'd be expensed when the goods were given to the customer. You take all the costs if they were fulfillment. But because these are costs from a marketing point of view, not a fulfillment point of view, what's new in IFRS 15, if the costs are not linked or incremental, in this case the salary, those costs are a period cost. If the costs are incremental and linked to the sale, those costs are capitalized and amortized over when we earn the revenue. Now I want to be very clear, it's still SG&A. It doesn't go to cost of goods sold. So you have prepaid Sga. This is new in IFRS 15. So what the standard is basically saying is we have two different models. We have an incremental cost model and we have a full cost model. The full cost model is for the IS2 aspects. And the incremental cost model is for the marketing side. So now marketing costs are capitalized. There's a practical expedient. If we have a time horizon of less than a year, those costs could simply be expensed. Yes?
Why do you say that this is new in IFRS 15? Because I remember that at the IS 39 and IS 18, we used to do this on banks before IFRS 15 also, where the commission is given on sale of automobiles, for example.
On loans.
If it is on an incremental basis, we used to defer the revenue along with the revenue of the cars.
I think what...
It is part of IS 18 also.
Well, in the past, what you generally found is companies took all their selling costs and expensed them in the non-banking sector.
I specifically remember that we got it done on a bank, and for that, over here in Pakistan, IS 39 is not applicable.
I know.
As an auditor, we were auditors at that time, so we had specifically given the of IS 18 that even under IS 18 this is not allowed to expense it completely. Like you have to take it along with the.
For marketing cost.
Yeah.
I don't remember.
It is incremental.
I don't remember that being an IS 18. I'll have to look again. I mean, the standard's been removed.
It was not IS 18, it was on the basis of general framework that we are getting benefits over the time. So we are
You mean the conceptual framework?
It was in IS 18 also. I can give you specific references.
I'll have to look at it because in practice, though, in the non-banking sector, in practice, commissions were expensed in day one. So if you were a telecom or any other obviously banks were different because banks would apply on loan products and stuff. They would match them for the EIR calculation. But for non-banking sector, the common practice was to expense them. So I'm surprised you said it was an IS 18. I don't remember seeing that. And the practice was it wasn't done that way. So you were the anomaly. So yeah.
Costs are amortized. They will go to selling expenses in P&L, or they will be net off from revenue?
No, SG&A. They don't go to revenue. The only thing that goes to revenue is cash received from a customer and cash and consideration paid to a customer. You don't take any of your costs to revenue, unless we have a principal versus agent issue, which is next. So this is new, that wasn't done before, which makes sense, doesn't it? I think it's interesting how they wouldn't allow the fixed cost to be capitalized and amortized, only the variable cost or the incremental cost. That was from the U.S. side, the U.S. influence there. So I'm not sure if that's going to stick for...
The car company gives commission to its dealers whenever they sell a car.
Yes.
Let's say if you sell X car, you'll get 100,000 commission. If you sell Y car, you'll get 50,000 commission. So what would be the accounting treatment at that time?
Well, you book the commission when you earn the revenue. So in your case, you have a PO point in time. That's easy. So when you book the revenue, you book the commission. If your agent was selling a car with an extended warranty, for example, and the extended warranty was for a period of 5 years, the commission would be split between the car and the extended warranty, and the extended warranty commission would be amortized over 5 years. If it's not material and it's a small amount of money, just skip it. But that's the idea. So in the telecom sector, you sell a phone, and obviously they have revenue over a period of 24 months. So yours is easier because it's a point in time. The issue is more when you have a service. Yeah. So if you defer the revenue, you defer the commissions.
Well, in this one common problem that that comes in is that a lot of banks, again I will tell you, that they have a policy that if you achieve one benchmark, then your commission percentage might be 5%. If you achieve a benchmark of 2 million, it will become 10% or 7%. So it increases after the benchmark. In that case, it is difficult to demonstrate that it is linked to a specific asset, and we might be required to recognize it upfront. The expense, we can't defer it.
You mean
along with
commissions
the-
for someone who gives you loans, right? You mean the loan agent?
Yeah. For example, if a bank is mortgaging, so you